You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast.
All right, welcome back, everybody. Brandon, how are you doing? I know you're not on too much sleep at the moment, so you're looking a little tired.
Yeah, I was on a holiday in Perth for the last few days, and I took the overnight flight back to Sydney, so I left Perth at 11 o'clock-ish, which is like 2 a.m. on the East Coast, and then got back to Sydney at 6 a.m. So I thought I was going to be able to sleep, because I can sleep on planes. But I don't know, I couldn't get comfortable. Whenever I rested my head, my neck was super sore. So, it was just a nightmare. I thought I was going to get like 4 hours sleep, but I got less than one, I reckon.
Yeah, that's
which
no
is not
good.
ideal. But yeah, when I got off the plane back to Canberra, I remember just thinking, there is no way I can do this podcast right now. So I went home, had a snooze, and we're recording a little bit later in the day. But yeah, I'm going to be a zombie today. But you know, it always makes, sometimes when you're super duper tired, it can make for some interesting podcasting moments.
Yeah, we'll see how it goes. I mean, yeah, we're recording in the afternoon, so even just that is, we'll make it interesting.
Yeah, we're always sleepy, aren't we?
Yeah.
We're always sleepy in the afternoons.
Yeah, because I mean, I always I always try and get up. I do my best work in the morning, so I always try and start early and finish early in the afternoon, because between, even just after lunch, if I have lunch at 1 or 2 o'clock, I just feel like the work after that period is so much less productive than when you wake up, have done some exercise, had a shower, ready to go. It's just night and day. So I'm usually kind of wrapping things up at 4 or 5, because I've started a lot earlier. So yeah, we'll see how we go.
Well, not today.
No, not today. Not today.
Hey, did you see, I thought this was a pretty fun. We got actually quite a few comments, all directed at you.
Yeah, I
all
think
of the comments from. Did you see that?
Yeah, you know what?
Why?
I didn't realize why that was at first, but then later I kind of realized it's because I shared it on my community board on my YouTube channel. So we probably had a good amount of people coming across from my channel who maybe didn't know about the podcast, which is something that I started doing just the last 2 weeks, and I noticed that our views on, at least on the YouTube version of the podcast, have doubled since I did that. So I'm going to keep doing that. So there's clearly a lot of you guys
I
who
should do that as well.
Yeah, there's a lot of you guys who didn't know that we did this, I guess, and or are at least kind of checking it out for the first time.
Yeah, I like this first comment. Hi, Hamish. This is so classic. Have you considered dropping the whole value investing thing and instead start shorting companies with integral CEOs, seeing as you keep scaring/killing them off? It's not a bad strategy, is it?
Yeah, I mean, I've only got, out of all the investments I've made, there's only one left that where the founder is still in place. Every other company that I've invested in that had a founder in place has either left or died. So, that's it's quite a track record. Whatever it is that I do in my analysis seems to line up with CEOs or founders getting ready to step away from the company.
Yeah, it's just sad. It's so sad as well. But you must feel so ripped off, because especially the ones where they just die. Occasionally, you had a couple of negative 10-20% days, I think, on the market's reaction to the founder dying or something like that. So you must feel a little bit ripped off. It's I did all my analysis.
Yeah.
How can I predict this?
Yeah. I mean, a lot of it is short-term noise, so it doesn't really matter for the long term. But yeah, you're not wrong. I mean, whenever a founder steps away from a company, it's almost always just an immediately negative response, unless investors generally want the founder out. I was thinking the other day, I think the one founder who, if they left, that the stock would probably go up is probably Mark Zuckerberg. I think if he stepped away from the company and the company pivoted away from the metaverse, I think not that that's necessarily a good thing for the business. I don't really know or care really, but I think in the short term, investors who love cash flow would be like, yes, he's getting back to his bread and butter, or the company's getting back to that. So
yeah, definitely. Or someone will come in and be like, cave under investor pressure. Someone that's not a multi-billionaire already. Yeah. I'll read some of these.
Yeah, what else?
Somebody also reminded you that that Bible, that really expensive Bible we were talking about last week, that the discounted cash flow is 0. So stay away. That's pure speculation over there.
That is true.
And I don't just mean that because it's a religious text.
Yeah. No, you're not wrong. You can't do a discounted cash flow with the Bible, but it still has value, I think. I think it's kind of ridiculous look, maybe not in the way that we think of value for investing, but I think it's ridiculous to suggest that no historical artifacts have any value because they don't produce cash flows. At least that's my view. I don't know.
Someone else told you to stop adjusting your mic every 30 seconds, you goddamn fool. I notice you do that a lot, but I do as well. Just like the little...
I mean, I'm a fidgeter, so if I'm not doing this and my hands are like off screen, I'm just doing this constantly with my fingers. So
really?
I'm just a fidgeter. I need a pen. I need to be doing something with my hands.
Did you get around the era of the fidget spinner?
No.
Did you have one of those?
No, I didn't. Yeah, I should have though. I should get one of those like fidget devices, there's like one that's like a switch that you can just like flick on and off, like a light switch.
Right.
Stuff like that. Yeah. Stuff like that would be really good.
My little fidgety thing is my feet. I bob my legs. I do the with my feet. But it's weird because on the podcast you can't. I'm doing it right now. You can't see my feet, but it still makes my upper body move a little bit. So I just look like I'm kind of just bobbing along in the podcast. Yeah, when I review the podcast, sometimes I see it and I'm just like, I'm fiddling with my legs. My body's just going dunk 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 dunk. So I need to quit that habit. I need to just keep my feet still. But yeah.
Yeah, I saw there was a comment, another comment. Dude, seriously, where the duck is this branding guy you mentioned in every episode?
All right, I get it. I'll re-record the intro for Christ's sake.
I think we should leave it. I think that's a really funny part of
meme.
it's just an ongoing joke for the Young Investors podcast. Who the hell is Brandon?
I don't even know what I would say. Welcome back to another episode of the Young Investors podcast. Sit back and relax as me. What do I say at the moment? As myself Brandon. That's what I'm saying. I'm like myself. I'm Brandon and my buddy Hamish. Well, what else do I say?
I think you've just got to say I'm Brandon
oh yeah,
with
I'm
Hamish,
Brandon and joining me as always is my buddy Hamish. Yeah, something like that.
Something to that effect.
Maybe I'll re-record that.
Let
me write that down.
I'm
Brandon. You reckon we should just leave it? Well, we get a comment every now and again. I don't know. Does it make us seem stupid? Because people expect there to be a third person. There never is.
Yeah, I don't know.
Brandon, and Hamish.
Yeah, sorry guys. Brandon couldn't join us again for the last 4 years. He hasn't joined us.
This mysterious third person that's also called Brandon. That's hilarious.
Oh, dear.
All right, enough banter, Hamish. What do we got to talk about today? We got the Fed minutes. They came out, and what are you talking about? Coinbase.
I'm going to talk
That'll be interesting.
Yeah, Coinbase had an interesting fourth quarter, and with the crypto market coming off a lot, the last year has been a bit of a disaster for some of these cryptocurrency businesses, and especially when we look into some of the components such as stock-based compensation and how much the executives are getting out of this while the investors are not making too much money. It's a pretty interesting story, and I also want to talk a little bit about a new deal between Microsoft and NVIDIA as the Microsoft-Activision acquisition continues to be pending, being held up by the FTC.
Right. Okay. And if we have time, I'll talk about Mercedes' new partner. They're partnering with a LiDAR company. And this is pushing it, but if we have time for this one as well, we might just talk about some chicken nugs.
Chicken nuggets. Okay.
Some chicken nugs. Yep.
Interesting.
Yep.
Okay.
We'll see. All right, let's do it.
Today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So you can bring in all of your trades either automatically by connecting your broker to Sharesight, or you can do it manually one by one, or by downloading your trades using Excel. Super easy. And once you bring in your trades, it will track all the gains and losses in your portfolio. So capital gains, dividends. If you have dividend reinvestment plans, it will do those calculations for you. Currency gains, if you're buying shares internationally or hold foreign currencies. I've mentioned this a bunch. That's super important at the moment. It's kind of a hidden return or loss that people don't really see unless you track it using something like Sharesight, especially if you're investing in the US from Australia or vice versa, or you're in the UK and you're investing in Canadian stocks. Whatever it is, there's been a lot of fluctuations over the past couple of years, really. So you need to be tracking the kind of your actual return, and Sharesight makes that super easy. And then you can also use it for when it comes to tax time. So Sharesight generates up to 12 different reports that can be used at tax time to work out things such as capital gains, dividend income, and more. At the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That site spelled SIGHT, sharesight.com/young investors. So use that link. You can sign up to a free plan and you get to track up to 10 holdings for as long as you want. So stocks, ETFs, bonds, that kind of thing. Or you can sign up to a premium plan for more features, more reporting, benchmarking against the indices and that sort of thing. And if you use our link, you'll get 4 months off an annual subscription. It's a great deal. Go check it out. And as always, thanks to everyone who has used that link when signing up and is supporting the podcast.
All right, let's start with the Fed minutes.
Yes, take us through.
Recap. So this is based off of the inflation data. We were talking about inflation data last week, I think. I think it was last week.
Yeah.
US inflation rose 0.5% in January. It was 0.1% month-over-month increase. The annual inflation figure continued to decline to 6.4%, down from 6.5%. And in that, I remember you talking about this. The food was up 0.5% month over month. Energy was up 2% month over month. Core inflation, which excludes food and energy, was 5.6% year over year. 0.4% rise month over month, similar to the past few months. So that's what we were talking about. I believe it was last week.
Yeah.
And now this week we got the minutes to the most recent Fed meeting. So it says here, Federal Reserve officials at their most recent meeting indicated that there are signs that inflation is coming down, but not enough to counter the need for more interest rate increases. Meeting minutes released on Wednesday showed, while the January 31st to February 1st meeting concluded with a smaller rate hike than most of what was implemented since early 2022, officials stressed that their concern over inflation is high. Inflation remained well above the Fed's 2% target. Yep, we can see that. The minutes stated that came with labour markets that remained very tight, contributing to continuing upward pressures on wages and prices. Consequently, the Fed approved a 0.25 percentage point rate increase. That was the smallest hike since the first of its tightening cycle in March 2022. The move brought the Fed funds rate to the target range of 4.5 to 4.75%, but the minutes said that the reduced pace came with a high level of concern that inflation was still a threat. Quote, participants noted that inflation data received over the past 3 months showed a welcome reduction in the monthly pace of price increases, but stressed that substantially more evidence of progress across a broader range of prices would be required to be confident that inflation was on a sustained downward path. Sounds about right.
Yeah, I think pretty similar to some of the summary that Jerome gave at the meeting or after the meeting in kind of the speech that he gives. So at least so far, it doesn't sound like there's kind of anything too new under the surface that's different to what they were actually talking about publicly. Seems like pretty similar. They want to be harsh on inflation and make sure they get it under control, which to prevent a repeat of what happened in the 70s where they kind of eased a little bit too early and caused or allowed a second and third inflation spike to occur. So interesting.
Yes, indeed. They have been very clear on their messaging that despite the rate hikes reducing in size, they're still probably not going to stop until they properly see inflation coming quite a way back down. I feel like their strategy is just like they moved very quickly while inflation was very high to get the bulk of what they needed to do done. And now from here, they can probably just move a little bit slower, make sure that it's just, continuing down in the right direction. But of course, if inflation does spike up, then I think we will see even more bigger rate hikes.
Definitely.
It says here, though the quarter point hike received unanimous approval, the minutes noted that not everyone was on board, not for why you might expect. A few members said they wanted a half point or 50 basis point increase that would show even greater resolve to get inflation down. Interestingly, market pricing still indicates the strong likelihood of another quarter point increase in March, followed by a couple more to bring the funds rate to a peak of 5.25 to 5.5%, which I think that's maybe what we predicted not too long ago.
Is it? Is that what we said?
I think so.
Yeah. Well, yeah.
Because we're obviously macroeconomists and we know everything. Yeah.
And our predictions are exactly what happens. No, but
interestingly as well, just before you start, if the rate would land around the midpoint of that target, it would be the highest funds rate since 2001.
That's interesting. Yeah, so it's certainly getting back to a much more normal credit environment very quickly. It's only been a bit over a year really that rate hikes have been happening, and we've gone from complete record rock bottom rates to now very much in the mix of what is normal historically. A little bit to the lower side still, but I think the long run average in the US since like the 70s is somewhere between like 6 and 8% was the federal funds rate. So it's still on the low, slightly on the low side, but yeah, it's very quickly gotten back to
back biased to now because it's been so low for so long.
Yes,
everyone's just so used to it. They're like, what?
Yeah,
I remember actually my parents were going through some of their old stuff, their old documents and whatever in their filing cabinet, whatever. When they bought their first apartment together, I think it was in Adelaide. At the time, interest rates were at 17%.
Yeah, crazy.
I saw, and it was like the actual document too. So I was like holding this document saying, your interest rate is currently 17.05% or something. I'm like, how on earth did you go? Of course, mind you, you could buy an apartment with like 2 or 3 years income back then. You can't really do that anymore. But
No.
So there's positives and negatives. But man, to actually have a loan put in front of you saying your interest rate is 17% and you going signing away, like my heart skips a beat.
Yeah, it's just hard to kind of comprehend. What's interesting is the situation we haven't seen too much kind of negative effects from the rate hikes, but it is interesting because just a couple of years ago, say in Australia, you had a lot of people kind of complaining reasonably that housing prices are so expensive, but at the same time, interest rates were so low. Now we've still got those high property prices, but with reasonably high interest rates. So now it's even much worse in terms of the actual cost for, say, a young person to get into the property market. So that is a very different situation to where, interest rates were a lot higher in the late 80s and 90s in Australia. But house prices were a fraction of where they are today. So
it's very interesting.
Yeah, it'll be definitely curious to see if there is a delayed effect to some of these rate hikes and what that effect is, and how it ripples out.
Yeah. Anyway, that's all I had on the Fed minutes. Nothing. We don't need to linger on this for too long because it's basically the same messaging that Jerome Powell has been saying in his press conferences. What would you like to talk about?
Let's talk about cryptocurrency because I know everyone here loves to talk about cryptocurrency, but no, it's a very I like to talk about crypto when it's funny, when we can laugh about it, a company or a cryptocurrency doing terribly or someone going to prison. That's where we talk about cryptocurrency. We've got
Charlie Munger having a rant on that most recent interview.
Yeah, I'm
crypto crapo.
Yeah, I've been inspired. by Munger's rhetoric. No, but Coinbase reported their fourth quarter and full year results this week, and it is really interesting to kind of look at because Coinbase is one of those companies where it's a cryptocurrency exchange, so it's in that space that's been impacted significantly by the recent downturn in the crypto market. But it's also a stock that IPO'd, initial public offering, in 2021. And I don't know if you remember, but it was definitely one of those companies or one of those stocks where a lot of finance creators were making a lot of content around it. It was very much at the forefront of a handful of very hyped companies, and at the time it was it's going to grow at 70-80% per year was some of the short-term projections on revenue. So it is an interesting case to kind of it's only been a couple of years, and to see what a disaster this stock really has been since that IPO. I don't know. Do you remember? I'm sure you remember. Like, there was a lot of people talking about Coinbase.
Yeah, well, it was okay. So IPO in 2021. That was right in the thick of the IPO
mania,
where literally any stock that IPO'd was going up 50, 80, 100%.
Yeah.
It was ridiculous. Like investors were just like, they couldn't help themselves. It's like Rivian. Remember that we laughed about it at the time. They delivered like 12 cars or something, and they're in that first quarter after their IPO or something like that.
Yeah,
and the stock price was just dung, 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 like kept going. It was so dumb.
Yeah, and
so crazy. Anyway, sorry.
No. Yeah, and Coinbase was like right at the end of kind of that mania because it really didn't experience much of a kind of a surge after IPO. It was really just down. But it was, you're right though. There was kind of, I think it was 2020 and then through 2021 as well. There was just so many IPOs as there is
just
kind of cash grabbing late market. And then eventually the IPOs start to just being a disaster. And this was one of them, but it was still a very hyped company. But essentially, it has been one of the worst performing stocks since its IPO. At its worst, it was down 80%, and it's now down where it is today, down 65% from where it IPO'd just a couple of years ago. So the stock has not done well, and a lot of it, of course, is on the back of this shrinking cryptocurrency speculation. There's still a massive cryptocurrency market. And people will make the argument for the store of value and a bunch of other things, but certainly over the last year, a lot of the fringe speculative, very gambly part of the crypto market has kind of been swept away. Where when there's whether it's unprofitable stocks or meme stocks, whatever it is, if something's going up a lot, you get people participating in markets that really don't know what they're doing, and you certainly had that with the crypto market, a couple of years ago, and that's kind of coming off. Revenue for Coinbase for 2022 came in at $3.1 billion, was down 57% year over year. So bit of a disaster. And in the fourth quarter, revenue was down 75% from last year. So their losses are really, or their loss in revenue is really accelerating, especially in the last 3 months. So it's not great.
That's certainly a negative growth rate, isn't it?
Certainly is. And Coinbase generates revenue in two key ways. One is transactional revenue. So fees directly tied to how much volume there is, how much participation there is basically in the crypto market.
Kind of like your brokerage kind of fee.
Yeah, exactly. That came in at $2.3 billion. That's most of their revenue, down 65% year over year. And then they have subscription and services, which is just these other little things such as blockchain rewards or interest on some of their loans. $793 million, which was actually up 53% year over year, but much smaller part of their business in terms of transactions and volume, down significantly as you would expect.
Yeah, ouch.
Unfortunately, expenses were not down, even though revenue was down over 50%. Total operating expenses increased to $5.9 billion, which represents a 23% increase. So expenses going up.
That's quite a lot.
Yeah.
That's quite a lot. I wonder why. I don't know this company at all.
Yeah, I'm going to get there. I'm going to get to
it. Sorry. Oh, yes. Of course you are. Yes. Sorry.
I hinted a little bit earlier about stock-based compensation. So we'll certainly work our way there. But operating expenses increased to $5.9 billion. So profit dropped from $3.2 billion, which they recorded last year. This year,
tasty.
It's not too bad, right? This year was a loss of $2.6 billion. So there's been about a $5 billion swing there. Which is not great. And yes, you're right. It is. It's kind of interesting to see their expenses go up during that period. Everyone might be kind of wondering why, and a big part of it has to do with stock-based compensation, which continues to explode. They unfortunately didn't do what they should have done, which is, executives being compensated maybe proportionately to the performance of the business. I don't know.
Don't think their stock-based comp would have been so high if
maybe
that was the case.
Yeah, I've got this great idea. Maybe someone's going to implement it one day where the executive pay actually matches the performance of the business. But
no, sounds dumb, dude. It sounds dumb.
Not the case. So stock-based compensation in a year where revenue declined 50% and they went from being reasonably profitable to very much a cash-burning business, stock-based compensation increased by over 100%.
Of course it did.
To $1.6 billion, which if you've got a good memory and you remember some of the revenue figures, yes, stock-based compensation is 50% of revenue. 50%. In an unprofitable company. And in the fourth quarter, this is where it just gets laughable. Stock-based compensation was 71% of revenue. So if you're wondering what that means, it basically means that this is a company where executives are literally just taking all the revenue for themselves.
Basically.
And leaving shareholders holding a company that is debt-burdened and extremely unprofitable. And reliant on a market that is very speculative, I would add. Although a lot of shareholders might not agree with that last bit. But yeah, it's kind of crazy.
I wonder who's taken what in terms of stock-based comp. I wonder who's taking what. I don't know.
As in
like who, like where, what, like what? Who's getting the sweetest deal out of this stock-based comp?
Yeah.
Like how proportionate is it through the different, managers and whatnot, directors, etc.
I actually looked a little bit at this. So we don't have the proxy filing for this year, so we don't have what drove compensation in that financial year. But I looked at the previous year, and you had, so in 2020, the CEO made $60 million, which is an enormous amount of money.
Holy moly.
I mean, it
$60 million.
Yeah, that puts him up with a handful of the biggest companies in the US, which those companies are profitable. So, it makes sense. And interestingly, the CFO who joined the company last year gave himself a nice $15 million stock award when no other executive got stock awards that year, which I thought was interesting. I don't know how he weaved that into the chief financial officer just weaved some like dodgy $15 million pay package in for himself. And then I was looking at the total administrative and general and administrative expense compared to the number of employees. And the G&A per employee is $350,000. So
what?
They're spending an enormous amount of money. So that kind of answers your question around, where's the money going? It's a company where at least on average, everyone's doing pretty well if you're an employee. So, so if you're a shareholder, you lose 80% of your investment. But if you're an executive, you make millions. So there you go.
Yep. Always better to be the executive, not the common stockholder.
Yeah. Yep. Exactly.
Yeah.
So there you go. I wanted to talk about that because it was just so laughably bad. In my view, of course. The stock was up on the news because that's exactly what you want to see. As
that's what
shareholder.
happens.
Yeah.
Rational markets.
But there you go. Interesting company.
Man,
I'm curious to see how it goes because I would imagine cryptocurrency, even though it's not something I participate in, I would imagine it's going to stick around as a market probably over the long term. It's just a matter of how big it is and what the market is for an exchange like Coinbase. I don't really know.
That's what an interesting story. That's just bonkers. That is bonkers. Like how, I don't understand. I should listen to maybe their earnings calls, but how is not every single question on the earnings call about stock-based comp? It's just like the first analyst gets on. Sorry, just had a question about stock-based compensation. So we're actually quite large shareholders in your company, and it looks as though, correct me, I'm sure this is not your intention, but it looks as though you guys have basically taken everything for yourselves and giving us nothing. And just like all the analysts just asking the same question over and over again. I don't know.
Yeah, it's mind-blowing.
I wonder what they'd even say.
Yeah,
what would they even say? What would the stingy manager say? Hamish, I don't like that you're taking so much of this stock-based comp. It seems like I, the shareholder, am not getting anything. What can you rationalize that for me? I don't quite understand. I'm sure you've got a reason for it. I don't even know what you'd say.
Honestly, I'd love to do this bit with you, Brandon, but I don't know what they would. I don't know. I really don't know what is the rational reason for taking half, even just half, but 71% of revenue in an unprofitable company. And I know it's not a cash expense, so they're not actually taking money away from the operations of the business, but they're just taking, they're diluting your ownership. But yeah, I really don't know how you can justify that at all. Just period. I really don't know how you can justify that.
I just didn't know. I don't know. Sorry guys. That's your answer. You're doing very well. I just honestly, I don't know. I'll have to review this with the team, and we'll get back to you on that. But no, that sounds excessive. So you're right. I'll have to look into that at a later date. But thank you very much for your question.
Did we make 1.6 billion? That's supposed to be 1.6 million. Wait, hang on a second.
Oops.
Oh, well,
how many zeros did I put on that?
Yeah, we'll get that fixed for you next quarter.
I'll just check.
Don't worry.
How many zeros are in my bank account? Oh, would you look at that? It was billion. My mistake. Oh, we can't fix it now, can we? It's already cleared. Anyway. Oh, dear, oh, dear. All right, let's talk about Mercedes.
What's Mercedes doing?
Mercedes. Yeah, this is interesting because it's, I like Tesla, and it's very interesting looking at different car makers' approaches to different, to autonomous vehicles and that kind of thing. So, interestingly, LiDAR maker Luminar said Wednesday that Mercedes-Benz will incorporate its sensors and software in a broad range of vehicles starting mid-decade in a significant expansion of an ongoing partnership between the two companies. Under the expanded deal, Mercedes-Benz will incorporate the next version of Luminar's Iris LiDAR into an upcoming partially automated driving system that will be made available on many future Mercedes models. Mercedes' new system will allow expanded hands-free operation during highway driving at speeds up to 130 kilometers an hour or 81 miles an hour, as well as enhanced driver assist features in urban environments. Luminar's shares jumped more than 25% following the announcement. Of course they did. Quote, we are now set to enable the broader scale deployment of this technology in the industry, Luminar CEO Austin Russell said. Mercedes standards for vehicle safety and performance are among the highest in the industry, and their decision to double down on Luminar reinforces that commitment. The deal builds on one announced by the two companies in January 2022, in which Mercedes-Benz said it would incorporate Luminar LiDAR in upcoming high-end models. Quote, in a first step, we have introduced a level 3 system in our top-line models, said Marcus Schaefer, Mercedes-Benz Chief Technology Officer, referring to last year's deal with Luminar. Quote, next we want to implement advanced automated driving features in a broader scale within our portfolio. So
there you go.
Do you have any particular insights or thoughts on LiDAR? Or should I just keep rattling off?
No, I don't really know anything about this company or LiDAR or anything.
Yeah. Well, I just found it interesting because Tesla, who I would definitely argue are the leader in autonomous vehicles, are not going down this route. But it seems like everybody else still is. And I can't remember if you recall in the media, there was a lot of stir because Elon Musk basically came out and said, if you're using LiDAR, then you're just dumb. And the reason for that is because back then, LiDAR systems were very, very expensive. So they just massively increased the cost of the car. So Elon Musk or Tesla's approach was just like, you know what, how do we drive a car? We use our eyes. We look around. So we don't need LiDAR. We just need a good camera system. And that should be enough. If you use artificial intelligence, if you use artificial intelligence with a good camera system, then you should be able to do it just fine. So, where was I? That's right. To be fair, on that point, Velodyne LiDAR, who are a leading manufacturer of LiDAR sensors, has developed a product with a price only 1/100th of those up until now. So the solution is definitely getting cheaper. Quote, the company's new model, its smallest so far, could be sold at around $100 in high volume production. A sensor system composed of multiple LiDARs is capable of 360-degree vehicle coverage.
Is LiDAR more effective, or what's the difference? What is LiDAR? I don't even know what it is.
Hang on, let's get a proper definition. It uses so cameras obviously in the visible spectrum, uses waves in the visible spectrum. LiDAR, I can't even remember what it stands for. Light detection and ranging. I think it's just different wavelengths.
Okay, I'll have to.
But it's very good at creating a 3D environment close around the car.
Okay. Interesting.
But Elon Musk was basically like, instead of having both cameras and the LiDAR, making a map around the car by bouncing photons around or whatever, he'll just use the camera system. But I wish I knew more about LiDAR, the actual technology, because I don't know much. Velodyne CEO Anand Gopalan has previously said, quote, past 2025, I think you will see the cost of LiDARs come down even more in the $700 range per vehicle. So there, and then Luminar Technologies, the one we're talking about in this instance, has now developed a low-priced LiDAR sensor priced between $500 and $1,000. But it's still interesting because no matter how cheap it gets, if you can create a system which isn't dependent on LiDAR and you can just use a camera-based system, it's obviously better. Just less parts, less cost. Even if it only costs $1, it's still better just to go with cameras. So it'll be very interesting to see if LiDAR actually gives the self-driving system more accuracy, more confidence, less collisions, something in that range. Or whether you can get AI to look through just cameras as we do. We're using these two cameras right here when we drive our cars, and whether they can make that better. And it's interesting that the mentality, Elon Musk's mentality is definitely about parts deletion, get rid of it. He's changed the whole way they build the body of the car to be 3 big mega castings, as opposed to having, hundreds of individually welded together bits and bobs that create the frame of the car. He's deleted a whole bunch of wiring out of the car. So when you look at a Tesla, when Sandy Munro, who pulls apart the car and says, wow, this is where your manufacturing efficiencies or inefficiencies are, he's like, I don't see how you have even done this. How have you built this car with such little wiring? It's ridiculous. Because most cars have kilometers and kilometers and kilometers and kilometers of wiring in them. So I just thought that this was very interesting. I'm obviously no expert, but there's definitely 2 approaches being taken at the moment. And I think it'll be interesting to see which one comes to fruition. Obviously, if Elon Musk gets his way and it works, that's a better system because it's all about minimizing cost. But it is interesting that a lot of the auto industry is still trending towards LiDAR.
Yeah, well, so, I mean, LiDAR would still be reliant on some sort of AI, right, to interpret what is being sensed, I would imagine. So at the end of the day, it's really going to come back to that, regardless of AI. In a way, that's kind of the core of what really matters, is how good the AI is. I mean, the sensors. I
think the thing about LiDAR is it's just taking in more information, overall, because it's just bouncing light everywhere and just receiving it back and making a map out of that. Whereas cameras, you're kind of just looking at the image and trying to make a guess about what the image looks like. Got
it. So I guess there's a bit of a different process that the AI might be easier for the AI to detect objects using LiDAR or something like that, maybe.
Yeah.
Okay. Interesting. Yeah. I don't know really all that much about this, except that I've seen those Waymo cars with the massive sensors on the top, and I think they use LiDAR, right? But it will be interesting. Very early days, of course, in this space. So we really don't know what of the 2 methods would be better for safety or for the AI, or even if there's another method that we don't currently know about that's going to be, far better. Whatever's being used first is probably not going to be the final form. I would imagine that's generally not the case.
LiDAR uses ultraviolet, visible, or near-infrared light to image objects. It can target a wide range of material. Oh, yeah, that's just like what it can look at. A narrow laser beam can map physical features at very high resolutions.
Okay.
So there you go. Interesting. Very technical. Geez, this does get very technical. Yeah. Anyway, cool. Less parts in car equals cost savings equals good for investors. Expensive LiDAR equals bad. Cheap LiDAR equals less bad.
Nice.
All right. Where are you taking us? Talk about this Microsoft Activision stuff.
Yeah. So the news this week, of course, Microsoft has been in the news a lot, trying to get this acquisition of Activision through the FTC and other countries and other regions. The news this week is that Microsoft has signed a deal with NVIDIA to bring Xbox PC games to NVIDIA's cloud gaming service. So this is kind of just another move Microsoft is making to try and stack the chips in their favor as they begin to enter a massive court battle with the FTC. So the story, of course, is that the FTC has blocked the Microsoft Activision acquisition. That's a bit of a mouthful. due to anti-competitive issues, antitrust issues. So Microsoft has kind of just been trying to do anything in their power to produce some evidence that they're not acting anti-competitively, so that they will win ultimately that court case and other court cases, which I'll talk about in a second. But as an example of some of these, as recently as December, Microsoft signed a deal with Nintendo to bring Call of Duty to Nintendo devices and consoles. So that was kind of a deal they did recently. I think we spoke about that at the time, which is it's kind of an interesting deal. I don't know how good Call of Duty is on a Nintendo Switch, but sure, now you can get it on there.
That'd be so funny.
It's very, at least to me, it seems very much like a performative deal to say, hey, look, we're not locking in Call of Duty just to our own cloud service. We're making deals. Look, you can play it on Nintendo Switch. If you don't have Game Pass, you can pull out your Nintendo Wii and you can
play it on your Tamagotchi if you want to.
Yeah, exactly. So now they have a new deal with NVIDIA, and it's kind of funny because last year NVIDIA expressed issues with the acquisition, and they actually took opposition to it, saying that it was a threat to competition. And there was Bloomberg was reporting that NVIDIA actually made a number of submissions to the FTC to say this is why it's anti-competitive. And then this week, they have now signed a 10-year deal with Microsoft to bring all of the Activision-Blizzard titles to GeForce Now, their cloud gaming service. And since the announcement, NVIDIA is now on board with the acquisition. So,
oh my gosh.
It's incredible. It's almost like... No, I won't even say it.
I cannot believe it. How has this happened?
It's almost like they leveraged the court battle for... No, of course. They couldn't possibly...
Hamish, hey, come on. Stop chucking around that.
Putting my tinfoil hat on. Hang on a second. Let me take that off.
Yeah, dear, oh dear, Hamish. Oof.
Couldn't possibly be what happened. That would be illegal.
100%. That's so funny. That's so obvious.
Yeah. It's very
and
interesting.
we withdraw all of the documents we ever submitted.
Yeah, we take that back.
And we apologize. Yeah. Oops. Did we say we were against it? Oh, silly us.
Yeah.
File an amendment just saying take out against and just put for.
Yeah, it is funny how transparent that is, but it's just allowed. Like they obviously, whatever. If they really did submit some stuff to the FTC, it's like, what was that evidence and why is that no longer relevant now that they're financially benefiting? And I mean, I guess you could argue that the deal shows that they're not acting anti-competitively, but it is still interesting. Microsoft said that they're still hoping for a deal with Sony, which is of course their biggest rival. They're hoping that they'll sign a similar deal to the Nintendo deal, which would essentially be...
Sign it!
Yeah, please sign it. Essentially would be a 10-year deal ensuring that the Call of Duty titles from that franchise come out at the same time on PlayStation and on Xbox devices. Sony is not signing anything. They still remain opposed to the deal. And I guess that's kind of it, right? They can't be opposed to the deal while at the same time making a deal with Microsoft for some of Activision's assets, essentially. Like, so they can't really sign a deal, even though it might be good for them. If they sign that deal, they're basically by proxy saying that they are in favor of the deal. And that would be massive for their court case, because that's really a big part of the story is, all of these games that are currently coming out on both devices going to suddenly be just exclusively Xbox titles or Xbox Game Pass titles. So yeah, no deal from Sony, and I think that's probably a little bit unlikely. Microsoft is, of course, as I mentioned, going through this kind of FTC court case, but that's not the only trouble they're having. European regulators are also looking into the deal at the moment. They haven't kind of filed any lawsuits or anything like that, but they're looking into the deal. And then we have UK's Competition and Markets Authority said this month that the takeover raises competition concerns and may result in higher prices, fewer choices, and less innovation. The regulator said that it could move to block the deal and suggests several remedies that Microsoft could take. One of those involved Microsoft divesting their business responsible for Call of Duty. So UK regulator is basically saying, well, if you spin off Call of Duty,
break it up,
then we'll let it through. And Microsoft basically said that wouldn't really make any sense, and that's not surprising. Call of Duty is arguably the biggest franchise in that deal.
For sure, yeah. Oh, yeah, it would be. Yeah,
probably in terms of revenue, I would imagine in an individual game
they've got
franchise,
like Warcraft and like those old school games. But you're right, like these days, Call of Duty would be worth a mozza. Yeah,
I think in terms of revenue, I think they were doing. It was an enormous amount of revenue. It was something like over $1 billion a quarter in revenue just from their free game. So I'm blanking on the name of the game that you just kind of buy gun skins and that sort of thing. This new model where you play the game for free, Battle Royale, Warzone, and can just kind of pay for things. It was making like $1 billion a quarter or something insane, which is enormous for a single game. So yeah, I think
it's crazy. Like I think when Call of Duty Vanguard came out, was that last year's game? No,
I think it was a couple of years ago.
Yeah. A couple of years ago. I mean, that was not well received, that game.
No.
But it was still like the highest selling game on the charts.
It's like a
consistently
default
the highest selling. Yeah. And everyone was like, oh, this game sucks. Still highest selling.
It's like a default purchase for a lot of people. It's just such a big franchise. So yeah, really interesting to see if this deal goes through, because at the moment it seems like they're facing a lot of trouble everywhere. Really seems like nobody's happy about. No regulators are really happy about this deal at all. So it'll be very, very interesting to see what ends up happening if that deal goes through.
You still in your Call of Duty phase, or I
haven't played Call of Duty in a long time. No.
Really?
Yeah.
You still watch streamers or not even?
No, not really. I go through like obsessions. I go through like patches. It'll be like chess, and then I'll be playing like 8 hours of chess a night, and then it'll be Call of Duty. It's just always something different.
When we were in the States last year, you were in one of your big obsessions with Call of Duty at that time.
Yeah,
I remember that when we were sharing a room, and I was just like nodding off to sleep, and you're just like watching the Twitch streams.
I was just on my phone.
watching Call of Duty streams. That was good. Good times. Good times. Can't wait for nothing.
Not yet.
No, nothing. All right, should we do so? We can fit in one more story. McDonald's. Get around them. New chicken nugs, everybody. New chicken nugs. Well, not here in Germany. McDonald's is expanding its McPlant line with another Beyond Meat item. The fast food giant announced last Wednesday that customers in Germany will be able to order plant-based McPlant nuggets starting 22nd of February. McDonald's, which has more than 1,400 locations in Germany, is also adding the McPlant burger to the country's menu. The launch comes just days before the 2-year anniversary of the companies announcing their 3-year deal for Beyond to become the preferred patty supplier for McDonald's McPlant burger. Since then, the burger has been permanently added to menus in the UK, Ireland, Austria, the Netherlands, and now Germany. McDonald's and Beyond worked together to create the new plant-based nuggets and tested them in 9 restaurants in Stuttgart in August. The nuggets are made from peas, corn, wheat, and tempura breading. But it looks unlikely that at this point that the US customers will get a chance to try the new McPlant nuggets for themselves, as the company's roughly 14,000 domestic locations. McDonald's and Beyond ended their US test of the McPlant burger in 2022 and haven't announced any plans for additional testing or a nationwide launch. I just found this interesting. It's not groundbreaking news. It's not going to change the world or anything. But I remember this was a long time ago on the podcast now. We were talking about whether Beyond Meat stood a chance. All of these fake meat companies stood a chance.
Impossible Burger. There's a bunch of them.
All of them, because all their stocks were going up and up and up. Oh, it's the new big thing, the fake meats and whatever. And the reason for that, I remember us talking about it at the time, like you compare a McDonald's to a Beyond Meat at the time, like nowhere near. The amount of money that Beyond was spending on R&D for their products, McDonald's could just like turn around and drop 10 times that amount. And that was our argument. We're like, I don't know if this Beyond Meat stuff's going to stick, because at the end of the day, competitors have so much more money. They could just drop a couple of years of R&D into it and just create something really, really good. But I think credit to Beyond Meat and their management for making sure that didn't happen by working their way into collaborative partnerships with these companies. Now, whether that holds true, obviously it said here it's a 3-year deal. Maybe McDonald's says, you know what, thanks, 3-year deals come to the end. We've learned all your secrets. Now we're going to do it ourselves kind of thing. Yeah, whether that's happened. But I mean, that could have happened from the start. So I still think that Beyond Meat maybe deserves some credit for actually collaborating.
Yeah.
And instead of just being trodden all over. I don't know. What are your thoughts?
Yeah, I think one thing we certainly kind of missed when kind of looking at it is that companies like McDonald's don't want to put a lot of capital to work to something that they don't know will be a big revenue driver or a big return driver for them. So it does make sense that they would go to someone like Beyond Meat and make these deals, at least in the short term, test the market, introduce a few products, a burger, nuggets, whatever it is, and then test it. And then if it's really profitable and it's growing, then maybe they get better margins out of, creating their own product. So that does kind of seem like the normal, natural kind of progression. One thing sorry, go on.
I was just going to say, it's almost like you can kind of shift a little bit of the liability onto Beyond Meat in that instance.
Yeah, exactly. What's interesting to see is that I know a lot of the discussion was that everyone kind of knows that the core market for Beyond Meat products is pretty small, but there was this huge argument that a lot of meat eaters would very naturally just shift over to meat substitute products, and I don't think that's really happened, at least so far. So that'll be interesting to see how that kind of plays out over time, because I know that was a big argument for these companies was we're going to get a lot of meat eaters who just want a good substitute, and as soon as there's a good substitute, if they see a meat product and a Beyond the Meat on the menu, they'll just go Beyond the Meat because that's easier and they want to make that choice. I don't think we've really seen that yet, at least so far. So at least the very small amount that I've looked at some of these plant-based food companies. But yeah, we'll see. It's early days, so interesting stuff.
Yeah. But there you go. If you're in Germany, go and give them a try. What are they called? McPlant McNugs.
No thanks.
McPlant McPlant Nugs.
No. Yeah, I won't be doing that.
I don't know. Doesn't quite roll off the tongue like a Big Mac, All right, should we do, with that said, that's all the stuff we're going to talk about for today. Should we do a couple of Q&A questions maybe?
Yeah.
For those that want to ask a Q&A question, I keep forgetting I forget you have to actually add the Spotify question box.
Oh yeah, on that, I checked the other day actually, because sometimes I forget too. So I went back to check, and it wasn't there. They removed it. So I'm not sure if
I just checked before and it's there.
It's back? Okay. So I checked. That's okay. So we'll have to add it again, because last week I checked and they actually removed it. So maybe they're like testing testing features and bringing them in and out. But that's okay. So it's back. All right. We'll have to,
Yeah. I've got episode Q&A box. Yeah.
All right.
You just have to. Yeah. I just forget to add it to the actual thing. Anyway, on the weeks that we do remember, you can ask us a question on Spotify, or the easiest way and the way that we get most of our questions is through leaving a comment on the most recent podcast over on YouTube. That is the easiest way to ask a question if you would like to. Okay. With that said.
Yeah, shall I read this one to you?
Sure.
This is a new question. It feels good to see the market in green, but just how long until we actually break even? The average retail trader, dollar cost averaging, buying and holding onto stocks. But it's like I'm up 5% today and down 17% next week. Yes, the market is very Darwinian. There's winners and losers, and it looks like I've been on a losing streak while others have been making huge six-figure returns in the same market. What strategies are these folks using?
Yeah, well, I wouldn't trust in any of those strategies that these other folks are using. Like obviously dollar cost averaging is a smart strategy. It's worked for a long period of time. We know that the stats are for like the S&P 500, it'll return you like 10, 11% per year. Not every year, but over the long run, you'll average out to that. Some years you'll be positive, some years you'll be negative. And if you're following that strategy, you've just got to trust in the long-term return. Like you can't be focused on,
Day by
being
day,
up today
week by
and
week.
down tomorrow. It's just going to happen. What you're really saying is that over a 10, 20, 30-year period, then you're probably going to have more green days than red, and you're probably going to have overall a positive return. Of course, nothing's for certain. Maybe that won't happen. Nothing's for certain in the stock market. There's always risk involved, no matter what you do. And there is no reason why passive investing will continue to work, even though it has done in the past. However, that's what passive investors trust. They trust in the long-term performance of the market, that if you're buying the S&P 500, that corporate America will continue to grow slowly over time and share prices will appreciate because business growth will be there. And you're just capturing that long-term trend. You're not doing anything fancy. You're not looking at other people doing fancy option strategies, because I guarantee you the people that are implementing short-term strategies now that are making six-figure gains in the same market, if you zoomed out and looked at their performance versus yours over 30 years, then you would win as the dollar cost averaging person. You would win. You would absolutely smash them.
Yep.
Yeah.
Yeah, I think it's a good answer. Yeah, it can be difficult, and
Thanks, mate.
I think I think especially when you're dollar cost averaging, and maybe you're not following the markets all that closely, and you're just kind of the average person trying to participate in the markets. Yeah, you've really just got to try and not get sucked into the short term news and what's kind of moving the markets on a week by week basis, because there is a lot of noise in financial media that really doesn't matter over the long term, as long as you kind of stay the course. So yeah.
Yeah. Hi both, love the podcast from Nashville, Tennessee. If you haven't seen a cotton field in winter when it's snow white, then you haven't really seen Tennessee.
What's that from?
I don't know. I just looked up someone from Tennessee talking on YouTube, and that's what they said. They said it like that. Haven't seen a cotton field in the winter when it's snow white. You haven't really seen Tennessee. Anyway, I don't even know if that's the right accent. I hope it is. It sounds right. Anyway.
Oh dear.
Sorry if I just offended everybody that lives in Tennessee.
Oh boy.
Question about your psychological mindset when investing. What biases are you most susceptible to when making investments?
Yeah, I mean, there's a lot of biases. Actually, it might be interesting to talk about one that Munger kind of spoke about recently on the Daily Journal meeting, which was denial. And he was kind of talking about denial from a fund manager perspective, which is that a lot of fund managers don't beat the market, yet they charge fees. So they have to kind of live in this kind of denial of the fact that
I don't believe that.
They're not really.
I don't believe that for 1 second.
Yeah, exactly.
Sorry, that was low-hanging fruit. Low-hanging fruit.
So he was talking about denial kind of in that respect, but it certainly applies to the individual investor as well. And I think one way that it applies is that if the facts change for a business and the long-term thesis for a company changes, it's often very difficult for you to let go of an investment. It's something that I've experienced, and you kind of do get into this denial kind of situation or bias where you don't want to believe that the story has changed. And that's a really difficult line to walk, because we do try and ignore short-term noise all the time, but we can't be ignoring actual fundamental changes to the businesses that we own. So that's kind of one bias that I think is
harder to turn your thinking around as well when you're actually looking at a paper loss as well. When something's fundamentally changed, but you're also looking at a paper loss and actually being like, oh, hang on, have I made a mistake? Do I need to take action before I cop a further loss? That could be really tough. And you're like, no, it'll bounce back. That classic, denial.
Yeah.
Oh, for me, I think definitely my mind just immediately goes to confirmation bias, just seeking out information that agrees with your viewpoint on something and dismissing or downplaying evidence to the contrary. I think that's very, very common in investing, because at the end of the day, people sink weeks into researching a company. You don't want to get weeks deep in researching a company only to figure out that you don't want to buy it.
Yeah.
That it's not the right stock, that it's a poor business. Like, come on, I've spent so you kind of start looking for things that, oh yeah, this person online said it was good because of this. I thought that was a good characteristic of the business, so I'll invest. Oh, I won't mind that it's got $1 trillion in debt. No, that'll be fine. What? That's what all the analysts are saying as well, that it's got too much. No. That's fine. I wouldn't worry about that. What do they know, the analysts?
Yeah.
Honestly, sometimes that is a fair reason. It is fair to say that about analysts. But no, I think confirmation bias for sure.
Yeah.
Would be the biggest bias that I would be cautious of. But yeah, you're right. Denial is another big one. Yeah.
All right. Should we, we'll wrap it up there for today. Thanks everyone for tuning in. And as always, if you have any questions for next week, if you're on Spotify, you can kind of swipe up below and ask your questions there, or head over to the YouTube version of the podcast and just click on the latest episode and leave your questions as a comment on the latest episode. And each week we'll try and save a little bit of time at the end to answer a couple of questions. As always, thanks Brandon for joining me.
All good, mate.
Thanks Sharesight for sponsoring. Sharesight.com/young investors if you want 4 months off an annual subscription or just want to try out their free plan. So go check it out. And we will see you guys next week. See you later, guys.
See you later.